Another news today, Tiger Brands reporting a dip in headline earnings for its year to the end of September. The group hit by a very expensive product recall and also that violence in July. SA's biggest food manufacturer seeing revenue tick up by 4% to 31 billion rand, but headline earnings falling by 5.7% to 1.87 billion rand. It's the owner of Oros, Koo and Jungle Oats. They took a hit from once-off costs related to the violence that occurred in KwaZulu-Natal and Gauteng in July. The group also recalling around 20 million canned vegetable products from the Koo and Hugo's range due to concerns around defective welds that do pose a risk of leaks. The costs amount to around 732 million rand before tax.
The numbers actually look quite solid, and I mean this is on top of civil unrest and everything else that we've been seeing through the period. They also didn't do as badly as some of the other industrial counters on the JSE through the hard lockdown. Of course, people were still eating at home, and this would have benefited the likes of Tiger Brands. So with that in mind, they actually performed quite well. The results were also very well guided for. So if we look at the market reaction, there really wasn't one. And yeah, I mean, revenue growth of 5% for a company like Tiger Brands, as large and complex as it is nothing to frown upon.
Joined now by the CEO of Tiger Brands, Noel Doyle. Noel, good afternoon to you and thank you for your time. It's been quite a difficult year for the country in some ways. Some of those difficulties have obviously affected your business.
Yeah, good afternoon, Stephen, to you and your viewers. It has been quite a challenging year, but I suppose if you've worked at Tiger as long as I have, challenging years are not something new. So, you know, I think the team has sort of coped pretty well with virtually everything that's been thrown at us. The most recent, of course, being the challenges around power supply that came from the previous article.
How much of an impact is power supply having on you? You obviously need electricity to produce what you produce, to produce food.
Yeah, it really just drives up our costs, Stephen, and adds to the complexity of operations. We are in a fortunate position that over a number of years, in response to intermittent phases of load shedding, virtually all of our facilities now have the ability to generate their own power through backup generators and the like. So it doesn't disrupt supply, but it does come at a cost and an additional complexity. And of course, it is driving us to look not just for all the good reasons around sustainability and climate, but we're also looking at 4 of our sites running some pilots around a power purchase agreement on solar power.
And the violence in July, particularly in KZN, how much of an impact did that have?
That impact was very significant. We've called out 85 million rands in the results, and that's because that's what we can quantify. Physical damage to our sites and physical stock removed. But we reckon it probably cost us another 100 million rands in profitability in terms of cleanup costs and lost revenue as a consequence of not being able to supply because of the theft. That number, is very difficult to give you an absolute number, so we haven't kind of made noise about it. But I think it's cost us between, 180 and 220 million in the aggregate, which is not insignificant. That's about 6 or 7% of our operating profit in a normal year.
Sure. And the recall of these canned vegetable products, it's a pretty big recall. I mean, it's going to cost you a pretty penny as well. 700 million rand or so. I mean, you have to put aside a lot of money for that. And I imagine you must be pretty irritated that this happened.
Yeah, look, I think it's extremely disappointing for us. I mean, it's disappointing for our consumers. It's disappointing for our customers. And at the time, it was obviously quite a morale-sapping blow to an organization that was beginning to generate some positive momentum in terms of its operating performance. But it was, one of those really very difficult to predict issues. We had to do the right thing. And from our perspective, Stephen, the most important thing here is that we were able to act proactively, identify the issue proactively, and got to it before there was any risk of putting a consumer at danger.
You've had some issues with your operations in Nigeria. You do operate in other countries. You had a little bit of a trademark dispute with a former distributor there. That's been resolved. Does Nigeria, some of the South African companies have had problems in Nigeria. Are you finding it difficult to operate there, or do you think things are getting a bit smoother for you?
No, I think it will remain a very challenging geography to operate on. Operate in, foreign currency liquidity issues are a challenge. Route to market is a challenge. We're very happy that now that we've, found an amicable parting of the way with our partners at UAC Foods, effectively we've cleared the table. We can take, some cautious steps back into that market more comprehensively with our portfolio. We'll do it slowly and steadily. We'll pick up the learnings that we've got and accelerate slowly. It's still an attractive market for us. It is difficult, but sometimes, the biggest prizes come with the hardest effort.
I don't know if you're able to give us an answer to this, but you're one of the companies that maybe tells us how the economy is doing, and I say this because people are very worried about rising food prices. You sell sort of goods at the bottom end of the market and towards the premium end of the market as well. Are you seeing people making different choices? Are you seeing people maybe moving away from premium brands to cheaper brands, substituting, basically trying to make their rand go as far as it can?
We're definitely seeing that over a period of time. It's been quite interesting. In the current year, the stats that we look at show that the cheaper brands, or sometimes those cheaper brands are the house brands offered by the retailers, for the first time in a number of years, showing a slight decline in market share. We think that's a function of the fact that big branded offerings like ours are often heavily promoted. So we're seeing consumers become increasingly savvy, switching from retailer to retailer, buying when there's some great bargains in terms of advertised promotion, pantry loading where they can. I think what we're also sort of seeing, Stephen, is as we came out of lockdown, we started to see, some signs of a slight uptick in terms of overall volume in the marketplace. I think we may see that kind of coast through to Christmas, but the global supply chain sort of issues that you're seeing in terms of shortages of supply, as well as the level of consumer inflation or producer price inflation, I think after Christmas we're going to see that flow into the CPI, and I think we're going to see some serious pressure on the consumer after Christmas. It's normally difficult to pass on price increases in this quarter. The way that you work with our retail partners is that you try and book your promotional slots, fix your pricing all the way through to Christmas. That's often done by the end of September in many cases. And even if you receive cost push, generally the producer has to deal with that, and the retailers won't adjust pricing until early in the new year. That's my feeling. So I think some tougher times to come, and obviously not helped by the slight adjustment in the repo rate that we saw yesterday.
Noel Doyle, Brands CEO, I do appreciate the time. Thanks very much indeed. The results out today.